welcome to the Final Bar. I'm Greg Schnell, the host of the show. This is the show where we check out the most interesting charts to get set up for the following week. With some intermarket studies, we'll be finding out the inflection points for minimum risk and maximum reward. And we do need a few inflection points this week. It's been a pretty rocky start. As everybody knows, October's been down hard basically since the beginning of the month. And so today we're going to cover off a couple of things. A lot of my friends have the deer in the headlights look. They don't know what to do now. They don't know what they want to do because they're wishing that the market will go back up to let them out. We're going to talk a little bit about the gold sector, which I had mentioned last week, and we're going to focus on this major market top. So I think it's major market top setting up here. Probably the top is behind us, and now we're going lower. So I'm going to cover that off and why I think that way. But this deer in the headlights, basically, we're going to try and look for charts that are starting to set up that are strong enough to withhold this downtrend. And essentially, when the market actually does start to run, these stocks should pop like balloons held underwater and just go straight up. So that's kind of the hope that we're going to look for, or the plan of attack for the next period. Okay, let's get into the charts. And what I want to start with today is I wrote a blog, and it was a little bit bearish, but is a major market top in. And one of the hard parts that we deal with in the industry is that if we see a top structure and we start to call a top, then all the people who don't think it's a top think we're just we don't have any information and it's not really there. And, all the economic indicators are still bullish. So how could this possibly be a top? So one thing that's important to realize is that the stock market tops before the economy tops, and it bottoms before the economy bottoms. So what we want to be aware of is if that's going to happen. So today I'm going to cover off a few things in this blog, and you can go click on this in the Canadian Technician blog. So you would click on the blogs tab, go to the All Stock Charts blogs, and then click on Canadian Technician. That'll bring you to a whole host of them. And the latest article from October 15th is there a major market top? So what types of indicators can help us see tops? So I'll just show you one that I use. Is it showboating to call a top? And again, we're not trying to showboat. We're trying to put together a package of information that when we compare different markets around the world, it's starting to show us the same conditions that showed up at previous market tops. And at least we should be aware of that. Now, if the market rolls over and then turns back up and immediately gets bullish, then we can get back on the train. But it's more important to be aware of the potential for a big, like long-term market top and take action against it, either by puts for positions you still want to hold or something like that. But the problem is if you don't do anything and all of a sudden you find out your capital is evaporating, then you don't have anything to invest when you start to get the bounce at the bottom end. So that's the idea, is to pull out, get some capital, market pulls back, all of a sudden we start to get breadth improvement, we start to get positive divergence, and lots of things are starting to set up. And when we start to see that, then we can get back into the market at a really low level and try and be more aggressive just when everybody else is probably puking. So we want to find those important bottoms. Okay, so when do you actually get a sell signal? And I think, somebody said, well, you can't call a major market top when you're in real time. And I'm thinking, okay, well, the market topped, in my opinion, October 1st. So here we are mid-month and we're talking about a top. Now, I don't want to be fear-mongering or whatever, but I want to show you how I come about that rationale. And the point is, here's just a chart, and I haven't placed this last line tightly, but you'll see I put this line on here, and essentially it's a nice 5-year trend line, and it breaks, and that was not a bad place to get out, the year 2000. There was a big wave here in 1998, was the Asian financial crisis, and it pulled back hard. It was about a 3-year uptrend there, and you can see the market was moving pretty aggressive. Now, this is a 25-year chart, so all of these look like they have a very aggressive slope. If you only had a 5-year chart going, the line would be more like a 45-degree angle. Then the 2002, 2003 low ended up finishing off in 2007. And you could put the low off of these anchor points, but one of the problems you have about using that anchor point is that you can see that most of the touches are on the line. So I could have drawn one here and a touch, and one here and a touch, and one here and a touch. So it's just wherever, as you stand back over the years and look, where's the most obvious place for the trend line? And so here, if we wanted to do that, we could draw one and it would go way out over here. Let's just say that that's a choice. So that is a fair thing to do if you wanted to try and generate a line like that. But the other thing that you're also trying to do is you don't want to wait until you've already had this big a pullback. And, again, okay, so let's draw our line. And that's a good place for the low, not so much for the high. So you're just trying to find some obvious places. And the important thing is that the last point on your chart should never be the second point. In other words, you need at least one. I thought I canceled all of the stuff coming in. You need at least one point, so a main anchor point, a second point, and your third point. So if this was the only other point on the chart, we don't want to use that as an end point to draw our final trend line. We want at least some points in the middle of the line to help us derive that point from. Okay, so the second thing to look at is we've got this PPO structure, and what I want to show you on the PPO is you can see back in 1998, the market was screaming higher and this PPO level was 12.5. So even with the big dramatic rallies we have had, 2014, 2007, all that kind of stuff, the percentage of the rally move hasn't been as fast as it was back in this big time. The problem with the MACD is it makes it look the same. And this is, relatively speaking, just convenient that they all, or coincident that they all kind of finished with the same sort of momentum high up around 600 here. And the reason I want to show the difference is if we take this same chart, and I think I've got it set up over here. So if I take this same chart and I compare it with, actually I need to use the one from the blog. I want to click on this one and it takes me in, and I've got both indicators here, but I want to put Amazon up on this chart. And the reason is it'll help demonstrate the difference. Now, Amazon was a $15 stock back in, here's $1.50 to $86 and now 2000. But look at what the PPO says is it obviously said it was pretty high and then came back down, and it's leveled out around this 20% level all the time. Look at what the MACD did. It was almost insignificant on all of these bumps, and now all of a sudden it looks just grossly overstated. So the PPO makes it look much more in trend with the actual development of the stock. So the percentage increase is kind of normalized here, and not so much if you use the monthly MACD. So again, we're going to use the PPO to help it because that helps us compare better over time. And it also helps us compare using percentages rather than using actual price. So if you had a stock that moved sideways, the MACD could work. But in this case, or in the index that we're trying to follow here, it wasn't really, the price is obviously a lot higher than it was at the previous point. So we want to use the PPO, not the MACD. Okay, so getting down to this chart now, on this one I have placed this red line tight because I have this anchor point that I described, and now you can see that this red trend line has been broken, and we're sitting right on the 20-month moving average, and this is for the New York Composite. And we can do this chart for the S&P or for the NASDAQ 100 or whatever. I've done it for the NASDAQ or for the New York Composite for a couple of reasons. And one is that in the past, it's also given very timely signals, even if the S&P took a little longer to kind of roll over. If you waited for the S&P signal to roll over, chances are your portfolio was already down about 10 or 20% before you kind of got the memo. We'd like a little more timeliness. But what you see on this PPO is every time the PPO broke and the price broke, is that this was a pretty good place to have exited the stock. So here's 2015, roughly January, and you can see by May it was that was where the market topped up in here. And so when the stock market is topping and you're getting indicators like your momentum indicators have rolled over, at least you've got a warning that you're in less stable times. Let's just be friendly that way. Now you can see here in 2015 and 16, we actually bottomed with a PPO right at zero. How convenient. But when you're in a positive environment and it stays above zero, that's a bullish place to be. And then you can see when it goes below zero, kind of, this is not a place you want to try and start to party. This is a place to really avoid. So this is just really big picture stuff. It's not going to help you with the day-to-day timing of the market or, when to get more bullish. But in general, since the spring, we've had a declining PPO on the monthly indicator. So that's just something to be aware of. Now, it could go like 2011. In this case, I don't think so because it's a big, long trend line. And we've already, we're putting in lower highs in momentum. And here, actually, we have lower highs, slightly lower highs coming in. So when we go look at this chart just on its own, the one thing that I think is very important through all of my work on the PPO is just the ability to draw trend lines on this. When it's starting to break, you want to get back in. And when it's breaking the other side, you at least want to be set up preventatively. Now, whatever, you have some stock you love and you want to hold it all the way to the bottom, just be prepared to hold it all the way to the bottom, and that's okay. If that's how you want to trade. But I think, if you're in whatever, some high flying stock, and I'll just pick, I've never looked at the chart, Workday or whatever, that stock has a really high volatility level relative to the market. So it's probably going to get sold off faster than others. And I haven't even looked at it. It could be hitting new highs today. But when it starts to roll over, it'll probably break down quicker. Okay, so from this, just to continue the article, so whoops, zooming out. So as we got down here, the point I want to make now is one of the things that happened is in the market in 2000 was there was an uptrend on the DAX, there was an uptrend on the S&P 500, and the DAX actually broke horizontal support, and that was a pretty good place to be aware of the trend change on the US market. And you can see that the US went on and tested the high of March in September and failed. So late September fail, no coincidence here. Anyway, all of a sudden it's starting to break down and it rolled down hard. We go to 2007 and we see the same thing. There was a big trend line on the DAX and a big trend line, I'm just going to shrink this a little bit, on the S&P. And what you see here is when this DAX trend line started to break, that was a concern. Now, by this point, the S&P was already putting in lower highs in December. The DAX was actually up here trying to make higher highs. And so it got up to this resistance zone. In a couple of weeks, it failed. It broke through its trend line. And within a month, it broke through horizontal support. And that was a pretty important place to be aware of. So as that broke, that was early 08. So the DAX still looked like it was ready to go higher. The US had made a lower high already, and it was the housing crisis, so it might have been more US centric. But you can see that when the DAX broke this horizontal support, it was a pretty good clue when both horizontal and trend support broke that it was a place to get out of. Fast forward to 2015-16, and what we see here is a horizontal support level gets broken, and then on the S&P 500, the trend line was here, and it got broken pretty significantly, but we bounced out of that, and that was the oil pullback. As oil broke support, the market kind of pulled back. Now, in this case, it righted the ship and went back up right away and got back on its bull train and started to run back above support on the monthly chart and took off. We spent almost another 6 or 8 months getting going, and the stock market ended up topping out in May. And you can see the DAX is building this horizontal level of support. It's actually putting in a lower high. And then sure enough, it starts to break down in August and things are getting let go. So as you break these upsloping trend lines, it's a place to be aware of. That would have got you July instead of August, where things really started to cave in. But as the DAX broke, you kind of want to be aware of that trend change. So here we sit in 2018, and what we see is the DAX has been building a horizontal base for a year and a half, almost 2 years, and it's just broken support. It broke its uptrend a long time ago, and now the S&P has broken its uptrend, and that coincides with when the DAX broke its support. So just on one market doesn't make a global confirmation, but it just suggests, okay, all of the pillars are in place for this to be an option. So let's go, what else could we check? One of the simple things in big picture technical analysis is just, are we above or below the 20-month moving average? And you can see in 2011 here, we dipped below it and got right back on our horse and got above it. Same thing, 2015, 2016. And so far, we're still above it in 2018. So what's to worry about? Well, one of the things that when I started to try to figure out when the market topping, because I don't live in the US, I also watch the other markets in the world a lot, because I watch Australia, England, Canada, just as commodity markets to see how they're behaving. And one of the things I noticed is when the US market started to fall below its 200-day move, or below the 20-month moving average, which would just be the center of the Bollinger Bands on a monthly chart, when all of the other world markets started to fall below that, that was probably an important place to be aware of. So you can see back in 2000, here's 2001, it took a little while, here's 2000. But as we go along, so anyway, here's the S&P 500, not failing yet, but here's the Shanghai, here's the Hang Seng, the South Korean market. The Japanese market has not broken down yet. Australian market is just barely below. You can see 6006. Oh, this chart hasn't updated. Let me do that. This was based on the data I published the article. So let's just go fast forward to today. So here's the DAX breaking down even harder. CAC, IBEX, this is the Spanish market. We'll go back to that other chart in just a second. Italy, England. So all of Europe is already below the 20-month moving average. If we go to the other markets I was reviewing, here's the Shanghai, and it's broken. The Hang Seng in Hong Kong, the Kospi in South Korea is broken. Here's the Nikkei, and again, it's still holding up. There's a little small trend line here for, I'll call it 2 years, that it has not broke yet. So that's one to watch. Australia, in this case, over the last few days, has pulled back above its 20-month, but I'll call it sitting pretty close to it. And then here's the Bombay Stock Exchange, still doing well, and that's a big one to watch, a billion people. And here's Russia, just barely, well, it's actually below this afternoon, but we could check it tomorrow when it might not be. And then here's Indonesia. And so just in Asia, there's big setbacks there. In Canada, we're below the 20-month moving average. And one of the other charts that isn't below the 20-month moving average is Brazil. So with all of these charts breaking down, one of the things, at the time I wrote the article on Monday, when we looked at when we get back through all these. The point I want to make is that I used a 20-month moving average, and typically, guys like Pring will use a 10-month moving average or a 12-month moving average to just say when it has a market rollover. So a 20-month is even slower, and we have a lot of them. So at the time I wrote the article on Monday, 13 of 17 markets with a Friday close were below the 20-month moving average. Okay, so to me, it looks like globally there's enough global pressure where we have that nice confirmation in the DAX of something that's happened every time, and it's breaking down. But we also have some indications on the US market alone. And the point I want to make here is this is the percentage of stocks that on Friday the 12th were above the 200-day moving average, and only 35% of them on the entire New York Stock Exchange were above. So what happens is if you look, when we got down to this 35% level, so this green line, I just move it every week to see where we currently are at. And what you'll see is just to the right of every one of these conditions, the market spent, a 6-month kind of time frame down here. So it wasn't quick. It took multiple months in the market. In the case of 2007-8, it was almost a year. Well, from 2007 high to 2009, final low was 18 months. But the other thing you notice on the bullish percent index is after you kind of drop this low to the right-hand side here, you can see that we had more lows to put in, and the market lost more momentum. So all of the setups are there for me from a perspective that is the major market top in. I would say we have all the conditions. So if nothing else, manage your portfolio as if things could fall apart quickly. And that might be a better guide. Okay. So having discussed that, one of the other things that and I think if you go back and look at all of the prior recordings, I kept talking about this bullish percent indexes and how they were breaking down, and they're sitting out there. The big thing that we need to watch for now, I think it's this chart here. No. Let me just check one more tab. No. Anyway, I obviously erased it. But the point I want to make here is we've had this big pullback, and now we've kind of hovered around the 200-day moving average, and everybody thinks it'll hold. Let's just suggest that this is an A, B, C move, and we end up down here trying to find support around the April lows. Obviously that would make for some big buying opportunity. And the bigger picture that I want to propose is that when you have a market breakdown and make major lows or whatever, just because we go down here and get to here doesn't mean we're done. What it does mean is we'll have the opportunity for a big, exciting rally with a lot of pent-up demand. And it's a great place to get on board and buy stocks, but not for 5 years. It might be for 5 weeks. But the idea being, when you have these big corrections, you get some sort of a rally, let's just call it 6 weeks, and then it rolls back over again, and you don't really know how big it's going to be. But if we just take this weekly chart, and I'm just, again, just going to pick some time frame here, whatever, let's go back and just quickly look at the last 20 years. And it works good to have the Alexander Elder colors on here, the red, blue, green. I've got a little too much information on here, so I'm just going to clear all of this off. And I'm just going to take off all my indicators for now. But the point is that on this chart, what you'll see is that when you have this downtrend, so you get a downtrend, you get green weekly candles, and then all of a sudden falls down again, green weekly candles, falls down again, green weekly candles. So these green weekly candles are just getting you interested again, and somebody's selling them to you, and then all of a sudden they break down hard. So you want to be trying to buy near the lows, not near the highs. And so you can't kind of wait for new breakouts. You have to bottom fish more than you would normally like to do, because then you can set your stop very close to where you entered. Okay, so the other thing you'll notice is that, like in 2009, there was hardly any green weeks out of this Alexander Elder system. And so what his system says is, on a red week, you can't buy. On a blue week or a green week, you can buy. And then you need to have the setup on the daily chart as well. So you're looking for things to start to improve. And we have other tools that we can use. But in general, you're going to be trying to buy. So as an example, Scott Redler has a system that where you're making these lows, and the moment the market goes below and then back above it, your actual buy point is right here. And if it goes and takes out this low, just get out. But if it actually goes below and starts to climb back up, then you want back in. And you want to try and buy here, because your stop can be so close, rather than trying to buy at the top of the candle that's now making new highs. So it's small systems like that that can help you. But the bigger thing is that it's important to watch that these shakeout rallies, like this is 100 points or something, these shakeout rallies are bear market rallies. So you're in a downtrend and they trend against you. So as we go forward now, let's just say that the setup is there for us to have bear market rallies. We're here, and let's just say, I don't want to compare to 2007 or whatever. Let's pick 2011, but we rally down. We end up with 2 or 3 weeks where we get a bit of a run up, and then it falls apart again. Same thing in 2015, 16, pull back, rallies up, get a few green weeks, and all of a sudden starts to fall apart again. So it's just important not to get your hopes up too much because you've started to have bullish weeks. You just need to really be patient and try and find good setups. Now, I was hoping to get the chance to talk about how we can go across the Stock Charts website and look for good setups. Unfortunately, we're going to run out of time to do that, so I'll try and make sure that that's exactly what we do next week. But just on an intraday picture, here's a 100-week period, 100-period moving average on a 10-minute chart. And you could just see we kind of get up, run against it, come down here, and today we fell back below it. We're starting to get a higher low setup here on the PPO. So perhaps this is exactly the sort of base we want to make to start heading higher. And then we'll get back up into this sort of 26.5 range on the Dow Jones Industrial, and it might be a better place to to sell our stuff off. But we have nothing. Like the PPO is not making higher lows yet. It's not even turning up yet. So I think we need to expect much more volatility in here. And even on this chart, if we got back up here, got to the 50-day moving average and fell apart, that would be a better clue of, hey, we started to touch 26,000. Let's leave this party. And on the weekly chart, you can see that we're trying to hold this 40-week moving average, and we've, held it for most of the year, but it's like 1 touch, 2, 3, 4, 5, 6, 7, 8, now 9, 10 weeks. We've been sitting around this moving average. That's just real long in the tooth. And in 2014, 15, same sort of thing. And then we finally broke through it. And as we broke through, it wasn't a good place to kind of just, hang on. We also have one more clue, and that is that we have this really big negative divergence. And what happens here is the price actually went on to make a higher high, but it was, I'll call it testing this high, and it basically Pinocchio nosed straight above it and then dropped below it. And as it dropped, went right through the 50-day or the 10-week moving average, got down to the 40-week, no surprise, it bumps there. And then all of a sudden, if it started to let go and lose all of the support from, I'll call it 2018, it's probably going to come down and at least try and test those levels, and that would be a place for the market to try and bounce from. So we don't know that that's going to happen. It's just kind of putting it out there. But as our PPO has already given us a lower high and a confirmed signal cross here, assuming the market doesn't go up 1,000 points tomorrow, we'll have a confirmed cross down. And when you get into negative territory on the PPO on a weekly chart, that's just a great place to avoid. There's no real reason to hang out. And so you can do two things. You can either just buy a put on the index to try and hold your position so you don't have to sell out of them. Maybe you don't want to declare the capital gains or all that kind of stuff. Whole bunch of choices to make. But the bottom line is you should either decide, I'm going to hold it, I'm going to sell it, or I'm going to put some sort of protection on the portfolio because we have all the makings of a major pullback. Okay, so just here in the last minute, the point I want to make, when we get these signals, we're not trying to showboat. We're just saying all of the charts are set up for failure, and until we start to see something, breadth improving or something like that, we need to be more defensive than we otherwise would. Doesn't mean selling your whole portfolio, but it definitely means managing it much differently than if you were in a bull market environment where you might let the stops run a little lower. In this case, you want to just snug them up, and if they get hit, they kick you out and you're done. Just try not to be too optimistic when that sort of thing happens. Okay. In big picture on the Dow, there is a whole ton of support at 23.4. And so I think the important thing to remember is as you go forward, don't get too bearish when it gets down there. That's probably a great place to look for a 10 or a 15% bounce and make your annual income or the percent return you were hoping for right then. And so I'll cover off next week. I'll try to cover off, what to look for on the website and how to go find some great stocks out there. And we'll try to cover that off for the whole show rather than discussing how the breakdown goes. So thanks for joining us on today's show. The Final Bar airs live on Thursdays at 5 p.m. Eastern. It can also be found on the Stock Charts TV schedule at other times during the week. In addition, you can look for it on the Stock Charts YouTube channel. With that, have a great weekend of good trading.